Welcome to the InterMarket Analysis Update. This is a video that I do every week where we look not only outside of the S&P 500 at other stock indexes and other markets within the stock market, we also look outside of the stock market to see what's going on in those markets to see if they give us any insight or clues as to what might happen with the S&P 500. This is being prepared for Monday, June 26th. The first thing we look at is valuation, both on a historical basis and on a forward-looking basis. Now, when we look back, this is called TTM, the trailing 12 months. That's what you see on this chart. And we have a series of things called PE ratios, or price to earnings ratios. When we get to certain levels, we're considered to be expensive. When we drop down below that, we're fairly valued. Or when we drop down even below that, we're inexpensive. Well, we have a PE ratio of 20, so 20 or above is expensive. Anywhere from 11 to 19 is fairly valued, and then 10 or under is considered inexpensive or cheap. Right now, the black line is the S&P 500, and it's well above the red line, which is a PE ratio of 20. So on a historical basis, the market is considered to be overvalued. Down below, I have a spread between the S&P 500 and the red line, and whenever we're above this zero line, that means that we are expensive on a historical basis. Here's another chart just showing different events that have happened and what the valuations on a historical basis were during that time. Then we look at another gauge called the Shiller PE ratio to help determine if stocks are expensive or cheap. Right now, the Shiller PE ratio is coming in at 30.35. Well, to get an idea what that means, the median and the mean for this indicator is between 16 and 17. So we're about double of what this measurement historically has been. So also on a historical basis, we are considered expensive. But the market doesn't do that. They look forward based on analyst expectations and forecasts. Right now, the S&P 500 is coming in at 18.9, which is under that 20 level, but above the 15 level. We look at the mid caps, they're coming in under 15 at 13.5, and the small caps are even a little bit lower at 13.3. And that's what we use to look forward, and that's what the stock market uses to justify current prices. Then we look at growth versus value. Here we have a pure growth index where the red line is on top of the blue line, so we are in an overall downtrend. We also look at a value index where this is also in an overall downtrend. But we get more insight by comparing the two. Here is a growth versus value on the top, and then value versus growth on the bottom. The reason why I do a lot of these charts and then I show you the inverse of that chart is because of the log scale, because of how moving averages can work, because of the different calculations. Sometimes we can get a little bit of a variation between these two charts, and so we just want to see both of them. And sometimes we see something in one chart that we don't see when we're looking at it in a different way. But growth is now starting to outperform value, where value is underperforming growth. Then we look at a couple of indexes, a growth index versus a value index, and growth is now starting to outperform value on this index. Then we look at an inverse of that same chart showing how growth is outperforming, or to say it another way, value is underperforming. Then we look at some ETFs. Growth is starting to outperform value, and then value is starting to underperform growth. And then we look at another index where it shows that growth is starting to outperform value. So we're seeing a lot of confirmation with this. Then we look at the small caps. Since the beginning of February, the small cap index has really been going down. It bounced back up a little bit, but now we're seeing some more weakness. Well, we can look inside of that and compare small cap growth with small cap value. And what we see is quite a different story, where growth is outperforming value. And that can suggest that the smart money is coming in and buying on weakness with the anticipation that growth prices will be higher in the future. Then we look at the mid caps, and this is a little bit stronger. It's also in an uptrend. Even though the mid cap index has really been under a lot of pressure, we're seeing growth really outperforming value. Looking how growth is really starting to outperform value, and this applies more to the S&P 500, and then we get an inverse of that same chart showing how value is underperforming. Then on a bigger basis, we look at S&P growth versus value, and this is chopping sideways. It's still in an overall uptrend, but it's not as strong as we would really like it to be. We also keep an eye on inflation. One of the measures that we use is the CRB Index, which continues to be in a long-term downtrend. This is a monthly chart. Then we take a ratio between inflationary areas and deflationary areas. The inflationary areas are really underperforming, meaning that the deflationary areas are outperforming. And this just suggests that right now inflation is under control. We're below the moving average, and the moving average itself is declining. We also look again at the CRB Index, which is in an overall downtrend on the daily chart. We look at the Baltic Dry Index, shipping costs from point A to point B. This is also in an overall downtrend. Some other markets, we just look at the aluminum market in a downtrend, corn in a downtrend, wheat in a downtrend even though it's bouncing back up, fertilizer in an overall downtrend, lumber, and this chart hasn't updated for a while now, but we're still in an overall downtrend. Oil continues to also be in a downtrend and has dropped below 70. Gas is also in a downtrend. Natural gas, even though it's bouncing back up, is still in an overall downtrend. Heating oil continues to decline. Diesel also is flattened out a little bit, but is in an overall downtrend. Copper, just about getting ready to give us a death cross here, but the 50-period moving average is just barely above the 200-day moving average. If we continue to see sideways to slightly down action, we will see a death cross here very soon. We also compare copper, which does well when the economy is looking better, with gold, which tends to do better when the economy is looking worse. And even though copper had really been underperforming, it's starting to bounce back up, but we did see some weakness later in the week. We look at a longer-term version of that same chart. That's the black line. We also plot the 2-year and the 10-year yield on here. They have a tendency to go in the same general direction and not get too far apart, even though they're on different scales. But now we're seeing a really wide spread between all three right now, suggesting there's a lot of economic uncertainty. Gold continues to be in an uptrend, but has been seeing some weakness. We have gold on the top, and then we have silver, and we can see that there's a really strong correlation between the two, which only makes sense, but this puts it more in a graphical way, using math to determine that, yes, they do go in the same general direction. Then we have a different study that we have here. So up on top, we have the gold to silver ratio. Below, we have the US dollar index. As a general rule, when the dollar index is going up, gold outperforms silver. When we see the US dollar index going down, silver tends to outperform gold. As I always say, both gold and silver could be going up. It's which one is outperforming the other one at any given time. Now, over a period of time, there's a really strong correlation between the two, but we're seeing that really start to slow down right now, suggesting that there might be some kind of a shift going on. We want to see this relationship turn and go back up, meaning that we can depend on this chart to give us some insight as to what's happening. Silver continues to be in an overall uptrend, but we are seeing some weakness. The dollar also in an overall downtrend, but it bounced up slightly this past week. The euro continues to go up against the dollar, but the Japanese yen has actually switched into a downtrend against the dollar, where the euro is still in an uptrend. And then here's the next chart showing where we've seen a death cross now with the ratio between the Japanese yen and the US dollar. The British pound, though, is still doing much better than the US dollar. Then we look at some different index ratios, and I show this in every day's video. We're showing that the equal weight index, which takes all the stocks and treats them the same, is underperforming the S&P 500, which is a weighted index, so the big companies have more of an influence. The Nasdaq 100 is outperforming the S&P 500, even though they both have been doing fairly well lately. The S&P 100, the bigger stocks, are outperforming the rest of the S&P 500. The S&P is now outperforming the CRB Index, or to take that another way, the CRB is underperforming the S&P 500. Small caps continue to show a lot of weakness when compared to the S&P 500, and they show weakness in and of themselves right now, unless you look at the growth to value ratio. The Nasdaq is really outperforming the S&P 500, even though they both have been doing fairly well. The Nasdaq 100 is really outperforming the rest of the Nasdaq. And here's the mega cap growth, comparing it to the S&P 500 equal weight, showing that the bigger stocks are really leading the market higher these days. We look at some other stocks. I show this in every day's video. This is the NYSE advanced decline line, where we're showing some weakness. We're coming back down to the moving average with the S&P. We're also seeing more weakness with the mid caps and the small caps. The 30 biggest software companies continue to be in an uptrend. Mega cap, this is where a lot of the strength is coming from. They are just almost going parabolic here. The robotics and AI ETF, it's been doing quite well, but it's seeing some kind of a pullback now. But when we compare it to the tech sector, it's starting to go back down inside of the rainbow and never really did outperform by all that much. Looking at the S&P 500 and comparing it with shorter term bonds, I also show this quite often in the daily video, where we're still holding up okay, but we've seen some weakness as the market was under pressure this past week. We look at another broad market measure with further out bonds, also a little bit of weakness, but still performing well overall. We look at the tech sector and compare it with bonds, where it's pulling back just a little bit, but is still continuing to outperform. The Dow Jones Composite Average, which takes the Dow, the transports, and the utilities, puts them all together. We're going sideways more or less, but we are still in an overall uptrend. Low volatility stocks, which held up well in 2022, they're coming under a bit of pressure in 2023, but we're still in an overall uptrend. But when you compare it to the S&P 500, they are really underperforming. FANG, we're keeping an eye on that. These are the big mega companies. It's in an overall uptrend, even though we saw some pullback this last week. We're looking at that all-time high, which is at about the 8,000 level. If we start to go back up, will this provide overhead resistance, or will we be able to break through this previous high? ARK also had a recent golden cross and has seen some weakness now, but is showing a little bit of improvement after it had been going sideways. We look at traditional Dow theory, which looks at the Dow and the transports, seeing a little bit more strength with the transports as of late. But I also include utilities in this, and we're seeing some more weakness. So that's more of a shorter-term negative divergence, where the longer-term negative divergence seems to be showing some improvement. Then we have a new take on Dow theory, which is represented by the S&P 500 on top, where we are pulling back a bit, but it's been doing rather well lately. And then instead of using the transports, we look at technology, which is the NASDAQ, and it's also really been doing well, even though we're seeing some recent weakness. Then we look at the S&P 500 on a monthly chart and compare it with stocks in Australia, Europe, Asia, and the Far East. We're still above this moving average, so we're tending to outperform. And when we look down below, the PPO is also starting to turn back up. Then we compare stocks with bonds. Here's the total bond ETF, which is just chopping around sideways, but is still in an overall uptrend. The Pring World Bond Index, also chopping around a lot, but is still in an uptrend. Stocks continue to outperform bonds on a monthly chart, and this shows on a daily chart where bonds are underperforming stocks. We look at the high yield corporate bonds, those are junk bonds, they continue to be in an uptrend. Then the investment grade corporate bonds, they are also in an uptrend, but doing a lot of chopping these days. Folks are still having a tendency to favor riskier bonds over more conservative bonds. They're seeking a higher yield. And in order to get that better return, sometimes they have to assume more risk. But that is what we see in a more healthy environment. We look at the stock to bond correlation, where it's pretty much neutral, but stocks and bonds are having a slight tendency to go in the same direction. The Dow Jones Corporate Bond Index chopping sideways, but still in an overall uptrend. Then looking at the 10-year yield, just to show you with some Fibonacci retracement levels, we're well above all of those levels right now. Then I added some more information here based on what Chris Shavaka was talking about in his weekly video. If you go back to 1980, you can see that we've been in a long-term downtrend with the yield on the 10-year. Are we starting to see a shift now? Are we going to go into a climate that we hadn't seen in 30 or 40 years where interest rates tend to be higher than they are now? We don't know that right now. We're just going to keep an eye on this and see where we go moving forward. Then the S&P 500 is outperforming the rise in interest rates. We saw that back in May, crossover positive with the ratio. Here's a look at the 30-year yield with some different Fibonacci retracement levels. And junk bonds continue to be in an overall uptrend. When we compare junk bonds to government bonds, junk bonds are outperforming. Then I also show this every day. We're looking at the bond ETF, where it is in an overall uptrend, but we're seeing the RSI below 50, even though it's showing a bit of improvement. The MACD is just starting to cross back over positive, and this is based on price. Then we look at yields, where we've been chopping more or less sideways. We go up and down. This is a daily chart. We still have a lot of yield curves that remain inverted, but in Friday's session, we did see interest rates come down slightly. Then on a weekly chart, we look at the US, UK, and Germany. Now the UK is in the lead because they bumped their interest rates 0.5% this past week. Their rates are now higher than in any other place for the time being. Down at the bottom, we have Japan. We're keeping an eye on that. That is their own scenario right now that I know a little bit about, but I don't want to keep talking about it over and over and over. However, I am watching that, and if things start to shift in Japan, I will be talking about that more. We look at the 5-year yield on a weekly chart where the trend is still up overall. Short term, we're looking positive. Intermediate term is still trying to roll over positive, but in the long term, we are showing a decline. And we use the KST to measure this overall trend. We also look at the 5-year yield with a daily chart showing that it's in an overall uptrend. But when we look at the special K, it's showing that we're in a downtrend where the KST is pretty much flat to going sideways. Then a long-term bond ETF, which continues to be in an overall downtrend because we're below the moving average. The short term seems to be showing a little bit of improvement. We're still negative in the intermediate term, where in the long term we continue to be positive. Then we compare bond prices with the CRB Index and make a ratio out of that, showing that bonds are outperforming the CRB. On a daily basis, we look at the MOVE Index, which measures volatility of bonds. That has been declining lately. We also keep an eye on the VIX, which measures volatility of stocks. That ticked up a little bit on Friday, but is really getting to a low level. The correlation isn't as strong as it has been in the past. On an international basis, longer term, based on the KST, China's market is showing some improvement. Emerging markets are now in an uptrend. Europe, even though it's rolling over a bit, is still in an uptrend. Seeing a little bit of improvement in Japan as well as the US. Looking at different sectors, the materials are underperforming the S&P 500. Communication is outperforming, and that's where we're getting a lot of strength from right now. Energy is underperforming the S&P. Financials are really underperforming the S&P. The tech sector is really outperforming the S&P. Industrials, we just saw a recent death cross with this ratio, so they are underperforming. Staples, also a recent death cross and continue to underperform the S&P. Utilities also really under some pressure as of late. Real estate also in an overall downtrend. Healthcare in a downtrend. Here's another look at healthcare showing how we're seeing some weakness on a relative basis. Utilities are underperforming the S&P. Now we flip that around and I measure the S&P against utilities because this often can give some real good insight as to the overall movement for the S&P 500, either up or down. Small caps continue to underperform the S&P. The red chart here is the small cap ratio. The blue chart is the S&P 500. Staples continue to be in an overall uptrend, but discretionary is just getting to the point of giving us a golden cross where it's starting to outperform the S&P 500. The tech sector is still in an overall uptrend, and when you compare tech to the S&P, it's really outperforming. Semiconductors are also really outperforming, seeing a little bit of profit taking as of late, but they've been doing really well since last October. Energy is really underperforming the tech sector, or to say that another way, the tech sector is outperforming energy. Growth, which are buy low, sell high stocks, and comparing them to bonds, growth stocks are really outperforming bonds. The tech sector is starting to outperform the rise in interest rates, and interest rates are starting to underperform the rise in the tech sector. Discretionary is now outperforming staples. That's growth versus value, where staples are starting to underperform discretionary. Gold is seeing some weakness now, but is still in an overall uptrend when compared to the S&P. We compare gold to the US dollar. We came up to this red downward sloping trend line. We bounced back below that. We'll see if we can get enough to get back above that, or will we continue to fall? High leverage loans. These are risky loans. And if the economy was getting ready to fall apart, would we see these going up like they are? There's a lot of smart people that trade this market, and they're seeing things looking better economically going forward. Then I have an InterMarket Analysis chart going back to the beginning of 2023. Stocks are in the lead, followed by gold and bonds, and then we have the dollar, where oil is now the underperformer. NYSE Composite, chopping sideways but still in an uptrend. The Wilshire, which hasn't been updating all that much lately. It's still in an overall uptrend. All stocks continue to be in an uptrend, even though we've seen some recent weakness. Emerging markets, chopping sideways but still in an overall uptrend. Bitcoin, which really started to surge after BlackRock said they might come out and do some kind of a ETF, really saw a real surge, and Bitcoin continues to be in an overall uptrend after seeing some weakness. We look at the home builders, not really telling us all that much now. We just keep an eye on this, looking for either convergences or divergences, but it's not really giving us any insight. Different correlations. We compare the S&P 500 to the dollar. They're having a real strong tendency to go in opposite directions. Where oil and the S&P, slight tendency to go in the same direction. The S&P to the 10-year yield is neutral right now. And the tech sector to the 10-year yield also neutral. The S&P to the 2-year yield, where they had been going in the same general direction, we're seeing that start to weaken right now as it heads back more to neutral. Some long-term and secular studies. Here's a monthly chart of the NYSE with the Copic curve showing that we are continuing to go higher. And then we look at the NYSE composite with the record high percent index. This is also showing a lot of improvement. We look at the S&P with the PPO, also looking better longer term. And we compare the S&P to the CRB Index, which also shows that the S&P is outperforming commodities. Then on a global basis, the S&P is still underperforming the global index with the KST, but we're still above the moving average on this chart. So what are positive and what are negative? There's only one change, and that was the Japanese yen. My definition of positive for this particular video is when the 50-period simple moving average is above the 200-period simple moving average. The big software companies are positive, the euro and the British pound. Copper, which could be getting ready to give us a death cross. Gold and silver are still positive. The mega caps, low volatility ETF, but they're really underperforming the S&P. The Dow Jones Composite Average, the FANG Index, as well as ARK. Bonds, when you take all the different kinds of bonds that we look at, are in overall uptrends. Staples, tech and semis, high leverage loans, the Dow and mid caps, the NASDAQ and the NASDAQ 100, the NYSE, as well as the Wilshire, all stocks, emerging markets, and then Bitcoin. All of these are in overall uptrends. What's in a downtrend? This is when the 50-period simple moving average is below the 200-period simple moving average. The growth indexes and ETFs, as well as the value indexes, they're both going down. It's just that growth is outperforming value right now. The CRB Index is in a downtrend. The dollar is also in a downtrend. The Japanese yen to the US dollar is in a downtrend. The micro caps and the small caps are also in a downtrend. Thank you. I hope you found this helpful. Please feel free to check out the daily video and the weekly video. I hope you have a great weekend, and I will talk to you in the next video.